Welcome back to Morning Trade Live. I'm Oliver Rennick. We are here in Philadelphia watching stocks get hit this morning as the 10-year yield makes another move to the upside. But it's not just bonds that are the issue. We've got some earnings applying some pressure. Let's continue to focus on the economy too, as we've got a lot to balance this week with GDP tomorrow. We just saw a new home sales print that was pretty good. How is that going to affect real estate investing? Let's talk about it with the team at LaSalle Investment Management. With $80 billion plus under management, Drew Dornbusch joins us, Managing Director at LaSalle. Drew, great to meet you. Good to have you here.
Great, thank you, Oliver. Happy to be here.
This is a huge week for the economy. What does it mean from your perspective and the types of funds, the types of real estate exposure that you've got with rates moving again? We got a little pause at 5%, but I mean, GDP is going to print 4% tomorrow, so I guess we shouldn't expect rates to go down anytime soon.
You know, I leave most of the prognostication to our research department at LaSalle, but I will tell you that anytime you have increasing interest rates, generally you're going to see downward pricing pressure on fixed income assets, one of which is commercial real estate, of course. So if we were having this conversation 18 months ago, I would have talked about how commercial real estate values throughout the United States were at all-time highs. Certainly that's no longer the truth. They've come back a little bit off that high water mark. But if we look specifically over the last 10 years and more generally over the last 30 years, commercial real estate has performed very well. So many of the investors that we work with are sitting on substantial embedded capital gains, and they're facing, if they sell the real estate, the associated taxes associated with such sale. So the department that I run and what I'm really focused on working with investors on a day-to-day basis is helping them execute on a strategy to efficiently transfer their wealth that is tied up in commercial real estate to the next generation of investors.
So it sounds like you're almost focused on sort of the tax efficiency side of it, because yeah, if you want to move a lot of money around in real estate, right, depending on when you got it, there's going to be a big factor that you have to include, you know, which is taxes.
That's exactly right, and I think it's particularly true of the baby boomer generation. As a group, they were the first to really embrace real estate as the third asset class, and if we look at the sheer numbers, as of today, it's estimated they own about $18 trillion of domestic real estate. In a couple of years, the youngest baby boomer will reach that retirement age of 62, and almost to a person, the individuals I work with would prefer to hold those assets over their entire lifetime and then transfer them through their estate to the next generation on an efficient basis. But there are specific characteristics of commercial real estate that make that a challenge. For an investor in his 30s or 40s, the idea of actively managing property, dealing with tenants, maintenance issues, and property improvement.
Not exactly fun.
Yeah, I mean, it may be appealing when you're young, or at least tolerable,
sure.
But as you get older and you reach retirement
But even when you're young and you do it for a few years, a lot of people say, okay, that's not for me.
I think that's true, and that's especially acute for a 70 or 80-year-old who's looking to de-risk his or her life, no longer interested in actively managing the property.
And these, when you're talking about a generation of baby boomers, I mean, a couple of crises, maybe since they've had that property or owned it or the house or whatever it may be, still very much up in value. That's where the taxes come in. You're going to have to be paying for that capital gain. How much percent and how does it depend on what type of property? Like, what kind of numbers are we dealing with here?
Yeah, that's a great question, and I think generally speaking, investors underestimate the taxes that are going to be due when they sell commercial real estate. They think only with regard to long-term capital gains, and for most investors that's going to be 20%, but it really only tells part of the story. If the investor lives in one of the 42 jurisdictions with state-level income tax, they're going to pay state income tax as well, and that can be upwards of 13 or 14% at the highest bracket, depending on the state in which the investor resides or the location of the property. And then in addition, one of the major benefits, as you're probably aware, of owning commercial real estate, you can write down the value of that property against the income during your lifetime of ownership. That improves the tax efficiency. But when you sell the property, the IRS is going to recover that that depreciated portion at a 25% rate. So that's depreciation recapture. And then you have the Medicare surcharge of 3.8%. This is a long way of me saying that most often clients are looking at a tax bill.
35%?
Yeah, in the mid 30% range. That's right.
Okay, so you manage a 1031. It's a trust that, where do the assets come from? Is it from folks that need help managing this to pass on or transfer their capital somewhere without getting that big tax hit?
Yeah, I think you've summarized it pretty well. Generally speaking, this strategy has emerged over the last 5 years, and it allows a client to sell appreciated real estate, invest the proceeds in a professionally managed portfolio that will provide some diversification, that preserves the ability for the client to efficiently transfer the wealth associated with that real estate to their heirs, and it puts the financial advisor in a position to, for the first time, manage on those assets.
So instead of selling their property, they basically take what it's worth, and how do you assess how much it's worth and what goes into the fund?
Well, generally speaking, this type of strategy would not have visibility into the client's appreciated real estate. The client would find their own purchaser for that property, they would sell the asset, and then they would invest the proceeds in this type of strategy on a tax-deferred basis.
But that specific process of taking the proceeds and putting it into this fund that the government knows is, you're not having to pay that tax, and you have your money parked there where your son or your daughter can tap into that fund later on.
Exactly. I mean, essentially what these strategies accomplish is taking the existing framework provided by the IRS, so Section 1031 as you referenced, and utilizing that framework to build an investment strategy that alleviates the client from actively managing the asset while still preserving the tax deferral and eventually the efficiency of transfer to the next generation.
Interesting. Okay, now what about like from the outside of an investor, from a portfolio management, like an asset allocation? Is this for, like, if I think about like an advisor here or something, is there another way to look at that product from like the buyer's perspective that maybe fits into like a portfolio or something?
You know, I think one of the limitations of owning commercial real estate bricks and mortar is exactly what you pointed out. There really is no opportunity for diversification, for asset allocation. With this type of strategy that I've referenced today, it provides the client the opportunity to diversify their interest across multiple properties in an actively managed portfolio. So for the financial advisor, it puts them in a position for the first time to really manage that position alongside the stocks and bonds in the portfolio and take a more holistic approach to the client's portfolio as a whole, and then eventually assist that client with estate planning.
It's like financial alchemy. Now you're like taking one thing and kind of turning it into another.
Yeah, I haven't heard that one before, but I think it fits.
Okay, very interesting. Drew, thanks for the insight.
Thanks so much, Oliver.
Something for us to think about for sure. Drew Dornbusch joining us from LaSalle Investment Management.